Scott, what is compounding and why is it important to us as investors?
Yeah, great question. The best way to describe compounding is with a saying that is, your money makes money. So there is the old quote, you have to have money to make money. That's true to some degree, but I don't want people to be put off. The reality is if you have $1 and you earn a 10% return, you got $1.10. If you earn a 10% return on that, you earn 11 cents rather than the previous 10 cents, and so on and so forth. So your dollar becomes 2, which becomes 4, which becomes 8, which becomes 16. You don't have to add any more money. You're simply relying on the returns, the money making money, making money, making money. That kind of, you're building a pyramid, if you like. You're building a constant growth into your investing. And that's what compounding is at its very, very core. It's not just earning 10% on the same amount. If you earn cash in the bank, you earn 2%. You earn $2 on your 100. Next year, you'll earn $200 on your 100. Next year, you earn $2 on your 100. That's a flat line investment. But if you compound, if you reinvest those returns or you keep those returns inside a portfolio, that's exactly how they compound. Whether it's reinvesting the dividends, getting higher share prices, hopefully also adding money to the portfolio. When your money making money, making money, that's the real asset of compounding. That's how you go from $1 to 2, 4, 8, 16 and on from there.
So it sounds like compounding is even more powerful as the percentage returns increase.
Yeah, it is. So you want two things, time and the rate of return. And if you can maximize both of those, that's where the real value is. The difference between 10% compound and 12% compound is not just 2 percentage points or 20%, the difference between 12 and 10, it can be multiples of your investment because you're getting the 12 every single year. So it's actually compounding that return value. And again, time is of the essence, right? If you can double your money every 7 years, which is about the average return on stocks over the long term, as I said, the dollar becomes 2, becomes 4, becomes 8. Now, if you stop there, if that's as much time as you've got, you stop there. If you can go one more compound level up to 16, that last compound is really where most of the value is. So the rate of return, maximize that where you can, and maximize where you can the length of time you're compounding for. Start early, leave the money for as long as you possibly can, get the best return you can. That's the secret.
I think there's a really interesting fact about Warren Buffett as well after his 50th birthday. Would you mind sharing that?
Yeah, so it depends on the numbers. Something like at least 95% of his current wealth was he basically earned after his 50th birthday. In other words, when he turned 50, he was already worth a fortune. Mm-hmm. Effectively, what that said was at that point, his wealth was going to increase 20-fold between then and now. And so that's really where the value is. That's, again, that same point of the last lot of compounding you do, because you're compounding the same rate of return on a larger base, that's where the value is. And that's, if you can start as early as you possibly can. The best time to start would have been 10 years ago. The second best time is today to get the most out of compounding.
Excellent. Thanks, Scott.
Thanks, Ryan.